Back with us here on Trading Hour, and as promised, let's get you a conversation going with Anirudh Garg, the partner and fund manager at Invasset PMS, who is joining us now to discuss the market fundamentals. Anirudh, good morning. Thanks a lot for joining in. I was going through your views on the market, and you were mentioning that you are seeing a typical distribution phase within the broader markets, but do you see this phase prolonging? Because we've been in a kind of market where every small blip in the broader markets, just as early as a couple of months ago, we've seen the broader markets falling 4%, 5% in a single day, and just within a week, they've recovered all of those losses. Do you see this as that kind of a phase, or you do see this distribution prolonging as we go forward?
A very good morning. Thank you for having me. I think that the distribution phase that we saw a couple of months ago, maybe in February, I think this is not the same thing that is happening. Look at the VIX, where it is going. It's at approximately more than a 1.5-year high. And we believe that whenever there is an event coming in, it is very easy to distribute among the confusion. So this is a classic distribution pattern for us that is happening in the market. And I think that the mid and the small caps, which have led the rally for the last 1.5, 2 years, are bound for big corrections from here.
Looking at some of those mid and small caps now, by the way, Lupin is reacting to weak numbers. Anirudh, just give us a second. I'm just picking some more stocks because the mid cap index is now looking at a 1,000-point fall. Let's pull up Lupin down 6%. SRF is now down 7%. Torrent Power is down 5%, and these are very well tracked. They're big stocks, and they're well owned by a lot of institutions and, of course, individual investors as well. There's Aurobindo Pharma, that's 5% lower. GMR Airports, 5.5% down. So it's a long list of losers out there. Zentech, Inox Wind, I could just go on and on, but it's a really weak market. Anirudh, so going back to our conversation, and you have been telling us that gradually, I think you're shifting away from mid and small caps and perhaps looking to position the portfolio more towards large caps. But how are you going about it? I mean, where are you selling your mid cap holdings? Where do you think the rally is perhaps best done now?
I think you'll have to look at it from a broader point of view. The entire mid cap and small cap segment, based on historical valuations, is now trading at exuberant levels, I would say. We shifted from mid caps and small caps to large caps back in starting to mid-February 2024, and we've been holding large caps since then. The most difficult thing for a fund manager is to not participate in the very last leg of the most participating or the most rising sector, the segment. The large caps, we believe that when we shifted to large caps, we believe that the upside in the large caps we shifted at around 21,400 levels of the Nifty, and we believe that the upside in the large cap would not be more than 10%, but the downside, on the other hand, should not be more than 10%. While in the mid and small caps, the downside could be as high as 25%. So, not willing to take that losses for our investors. Leaving the last few bucks on the table is what we believe in. We have been holding mid and small caps for the last 2 years now, and especially capex and capex related themes and interest rate sensitives, the old economy stocks. But we believe currently that they are in an exuberant levels. When your clients, they tell you that if you are participating in the large caps, we would want to exit the portfolio, or would ask you to please go into when you're not participating in the mid and small caps, the desperation is seen is where the markets, they mark their exuberance, and that was a phase that the market saw for the last 2 months. And we believe it is our duty to keep the risk reward ratio in check.
By the way, Surabhi was highlighting the fall that you're seeing in the mid and the small caps. Now 93 stocks on the mid cap index out of the mid cap 100 are trading with losses. Now compare that to the small caps, is no better. 87 stocks on the small cap 100 are trading with losses. But Anirudh, you are highlighting that you are still focusing on some interest rate sensitives and capex plays, and you expect them to do well over the next 2 years. What within the interest rate sensitives you are positive on? Because most of these real estate names have seen a significant rally over the last 12 months. Auto stocks have rallied significantly as well. The likes of Tata Motors and the Bajaj Autos almost have doubled over the last 12 months. Where within the rate sensitives do you find value?
Within the rate sensitives, I believe that the metals should do well. And going forward, if the inflation problem is solved. I see it going forward as the time period has passed and the Fed is not, Fed is just contemplating when to give a rate cut, and the rate cut, the rate rises out of question. So I believe that going forward, metal should be the flavor for the next 2 years. And then autos, we believe that have become very expensive, again, based on the historical risk reward valuations. While one of the most favorable themes, the luxury real estate, we believe after a correction, when we buy on dips, would offer a value again.
Okay, so just to sum this up, Anirudh, now, what's your advice to people as we look at gearing up for election, the volatility, and then what happens thereafter? And in terms of people who are still sitting on a lot of cash and have been waiting for dips to get in, I think that's where it's going to be interesting, whether you go back and keep riding the capex themes that you also mentioned, or is it best to look for some safety, maybe FMCG, for instance, where we are seeing buying after a very long time?
I think if we look at the overall trend is still in favor of capex and interest rate sensitives. So one should not deviate from the sector, but what one should focus on is going in through SIPs, maybe do the next 10 SIPs in the next 10 to 12 weeks. And whenever there is a decline, maybe double your SIP. And whenever there's a rise, maybe avoid at that time. Just try to position your SIPs better on dips. And I think it should be good. What you have to focus on here is that a lot of money has been made in the last 1.5 to 2 years. And as important is the generation of alpha in the market, equally important is the preservation of that alpha. So right now, I think the preservation of alpha mode should be on for the markets.
Preservation of alpha should be on the mind of investors, but that's a very pertinent point that you made, Anirudh. Thanks a lot for joining in and taking time out and sharing your views on the markets and your top sectoral preferences. That was Anirudh Garg of Invasset PMS. So take a look at the markets again. Now, PSU Bank Index is down another 2.5% after the 4% fall that it saw yesterday. All 12 stocks on the PSU Bank Index are down. All 10 stocks on the real estate index are down. And all 15 stocks, Anirudh was highlighting metals, all 15 stocks on the metal index are also trading lower. The realty index now down 3% as we speak. The metal index also at the lowest point of the day now, almost 2.75%, significantly lower from the highs of the day. Not looking good at all for the markets. But let's take a short break here. Up next, we get you the latest on the third phase of the Lok Sabha elections that are currently underway. Stay tuned, back on the other side.